Good afternoon. Welcome to the TheoTrade afternoon video. I am Blake Young. Today is April 13th, 2023, and today we're going to be discussing PPI Pokes Bears in the eye. Today, the PPI came out, Producer Price Index, which is an inflation index tracking how much it costs producers to buy their products before value add creation, manufacturing, and selling it to the consumers. Well, the PPI, as we discussed earlier this week, was expected to be higher. We expected producer price index or inflation data to show that it's costing producers more to make their stuff. And if it's going to cost producers more to make their stuff, it is a good indication that the producers are either going to eat that cost and lose out on earnings, or, which is negative to the stock market, or they're going to be passing it on to consumers. Their increased costs are going to go to consumers, which means PPI can be a foreshadowing of CPI in the following month. But if that's the case, that generally means less sales because the higher cost slows down the demand. So in either instance, rising PPI places the producers in a situation where they're between a rock and a hard place. They're either going to get less sales or going to get less profits from the sales they're getting. That's kind of their choice. Now, as PPI came out, we expected, again, the analysts expected to see rising inflation in PPI. And rising inflation in PPI would say we're still fighting inflation. Inflation is still winning out. Demand is still not where it needs to be. But prices fell. PPI showed a slip. So let's take a look at the PPI numbers. Then we'll come back and look at the technical view on the SPY here in just a second. There's a couple things to note with this month's PPI. Number one, PPI here shows that we went from the expected 0% to negative 0.5. Now, this was actually showing 0.1 earlier this week. So the forecast actually dropped. The forecast expected to see no inflation, no deflation, but it dropped. And then we also reported negative 0.5. That is negative 0.5 is an indication that we are not only not seeing inflation go up or increasing its speed, but we're actually decreasing and creating a deflationary or disinflationary type of situation. Last month, however, we actually raised it because last month it was negative 0.1, but we've adjusted that higher here. Additionally, we want to take a closer look at core PPI. Core PPI takes out the costs of energy. Energy prices fell in March. That would hit the producers first, meaning that they would save that money. And that's really what we're seeing here. Last month, we expected to see, or we had inflation go up higher and revised higher. We expected that 0.2% to happen this time, and it came in at negative 0.1. So that the difference here is almost exclusively energy. Energy prices fell, and it saved producers an additional 0.4% over what they would have if we had no inflation at all. So that's a big indication that this is almost all energy. So if energy prices are increasing, this can be offset very quickly. Additionally, one other thing to take a look at is this negative 0.5%. If we look at the previous months, we've had this negative 0.5% here, 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 and even back in 2020. But just in the last year, it happened in August and it happened in January. So if we were to look at these months and say, therefore, we're looking at the following months, what happened to the stock market in September of 22 and in February of 23? If we assume that that negative 0.5% would automatically mean lower inflation or disinflation, and therefore we're going to see equities rise because of the expectation of raising rates is going to diminish, we would be mistaken. Let's take a quick look at two different things. Number one, this negative 0.5, did it move the CME's expectation of a rate hike? And the answer is no. We're actually at 66%. Now, this has gone up and it's gone down, so it did go as high as 70%, but as we can see, yesterday was 70%. But from a week ago, we were 50-50 as far as not raising rates to raising rates, according to the CME's FedWatch tool. Now we're at 66%. We did spike as high as 70, but the PPI number only reduced the probability from 70% to 66%. That's not a big change for the expectation of still seeing rate hikes. So that's the first thing. We're not really pricing in a no rate hike in May, despite PPI showing a drop. So let's take a closer look at equity prices after PPI showed negative 0.5 this last year. Well, we saw that that reported negative 0.5 in August, and look what we did in August and September. So mid-August, this is when that PPI report would have come out. That was the top. We'd absolutely sold off. No indications of lower price or deflationary prices being an indication that we're not going to raise rates and therefore that it's going to be a free-for-all for equities. In fact, we sold off for an entire 2 months. As we look over here, and we did have 2 negative months in PPI. As we look over here to January, here's the January report. Here's February 1st, and we sold off all of February into the middle of March. So falling PPIs gives us no indication that we're going to see rising equities or that we're going to see lower probabilities of rate hikes. That's not in the cards. But what it does tell us is that if we have lower prices to producers, the companies that are producing and generally have the tightest margins are the ones that are probably going to benefit the most. So before we get into that, let's just quickly show you energy prices from last month to this month. We'll start with crude. Take a look at the picture there, and just so we can know that the majority of that, 80% of the decline in PPI was driven by crude prices or energy prices. Now, this is not a direct, perfect correlation, but just let me show you quickly. Crude prices, and we could do the same thing with XLE and energy prices in general, but if we kind of go back to March 1st, and we say from March 1st to March 31st, and there we go, and we can see that prices fell about 3% during the month of March, but they got as deep as 18% decline. So that 18% decline in energy prices, when prices are falling, usually that's when companies put on hedges. They don't expect energy prices to stay low, so they put on hedges and they protect their positions, or they buy excess oil, they buy excess gas as long as they are able to store it, or they hedge it with futures when they know that the prices are cheap to reduce their costs for the future. So they've probably already hedged this out, and they've already probably protected against this rally in many ways. And so I don't expect it to spike too high. But as we look at this just in this month so far, if we just go in the last couple of weeks, starting from that same end of the year, or end of the month, excuse me, we're already up 8%. So if we were to net 3% down, and that caused a 0.4% of the 0.5% decline in PPI, I think we can probably expect PPI to go higher in May. I don't see any indication that we're really going to fade from crude being up in the 80 to 85 range, maybe $88 range in the month of April. So PPI prices will probably go higher. The other costs that are associated with PPI outside of energy and the numbers we would be looking at, now, purely based off of the inflation data, not demand data, the inflation data, we can see here again kind of the walkthrough. There's your negative 0.5% that we saw. And as we look across here, energy, negative 6. Transportation and warehousing, negative 1.3. What else went negative besides energy? Well, transportation and warehouse. Transportation is going to have energy in it, even though we're not really seeing the direct line. It is directly connected, and so generally if energy is down a lot, transportation costs are going to go down. Warehousing usually doesn't change as much. And as we look at this, food costs not going down, just energy. That's it, all the way across. And even though transportation warehouse is down, that's still more energy than warehousing. So that's it. If energy prices are negative now and looking like they will not be negative in April, there's nothing else here that is showing negative inflation according to Producer Price Index on the chart. Food's up. Transportation, warehousing, if we take out transportation, warehousing is probably up. Final demand, again, showing that we're seeing an increase of demand. We're not seeing the slowdown, and this is almost exclusively energy. But if the costs are going down, who has the lowest amount of margin that requires energy and transportation? I think that if you were to look at the ones that are going to have the tightest margins in the past month, and then in the previous month they had the higher savings because they have the tighter margins, those companies are probably going to be ones that benefit the most for a dip in Producer Price Index. So if we go in there and say, well, where do we start? I would say we probably start with grocery. we take a look at grocery. In fact, I have a little chart here that I borrowed from SageWorks. And these are the least profitable industries, tightest margins, smallest amount of margin. You see oil and gas extraction in 2016. So this is, I'm not going to worry about the oil and gas from 2016, but I'm going to say overall, yeah, grocery stores only have a 2% margin. Or wholesalers, 2% margin. Grocery, 2% margin. Beverage manufacturing is 0.8% margin. And I can actually speak to that. My dad owned a beverage facility manufacturing company for a little while, and they're making such a small amount. 0.8% is what they end up having as far as a net profit margin. I'm not going to touch on automobile dealers. I think that's actually going to be sliding. But everything else here, I believe, is an opportunity. Because these companies require a lot of transportation. These companies require energy. You have to ship your beverages. You have to get all your groceries shipped to you. You have to be able to ship your vehicles out, frankly. Building materials and supply dealers, again, home furnishing stores, furniture stores, all of these have very narrow, tight margins. So when PPI drops and we go into deflation, generally speaking, it gives these companies, these types of companies, some wiggle room. They've raised their prices to be able to survive, and we've seen that at the grocery store. We've seen that with automobile dealers. We've seen that across the board. Everything costs more. So they've raised their prices. Now they have a month of reprieve. We could see multiple months of them gaining the difference in a little bit higher margin. Which means what I'm going to suggest, and yes, we could do healthcare as well, but what I'm going to suggest is that we come back here and focus on consumer staples and consumer discretionary. But specifically, we look at the Kroger's and the Walmarts. Kroger's, Walmart's, and beverage companies like Coca-Cola, Pepsi, and maybe down here, TAP, Coors Beverage Company. Starting out with Kroger's, we've had a nice little pullback. The question is, where do we want to buy? This has been in a very flat range going all the way back to May of last year. We've got highs near 50, lows near 42. As I was looking at Kroger and Walmart and Costco had a nice little bounce, but they've also seen a decrease in in-store, same-store sales. As I'm watching for Kroger, and Kroger's pulling back into this area, one of the things we might look at is saying, okay, if we're pulling back or we're seeing a dip, can I sell premium on Kroger for about a month's worth of time for 3%? That's one of my favorite things to do as far as selling puts. Can I sell puts at the money or just slightly out of the money? And can I collect 3% for a month? Now, we have a May 12th and a May 19th, but let's take a quick look. You can see here we are, May 12th, May 19th. This is the regular monthly option on the May 19th. And if we look out the $47 strike is going to pay us roughly 3% to be willing to be assigned Kroger. So Kroger is at $47.05, selling the 47. They're willing to pay us $1.23. If we get assigned, we're buying it for $45.77, $45.75, somewhere in there. And without even looking at the charts, we could do the same thing with Costco. And Costco's current price, $4.97, and it had a great day today, $8 up. So 2% climb in Costco. But even still, they're willing to pay $10 for $4.95. Now that's only about 2%. So Kroger is a better payment for that level. Walmart, you see down here, they're willing to pay us $2.25 for $1.45. And that one's the least of the, as far as return, that's only about 1.5%. So going back to Kroger, this is probably my favorite one as far as the setup goes, because we can get paid about 3%. And as a quick side note, what you can do is on their layouts here, if you're using the thinkorswim platform, you go to layouts, you go to customize, and if you go down here to return on risk, click on OK, you'll see it doesn't give you a percentage. This is telling you that if you're going to buy it at 47, but because you've been assigned, because you've got paid 123, that is 2.72%. And we can extrapolate that. This is roughly 2.7% per month, and that's 32% annual. And we'd have to adjust it down for those 6 days, but that's sizable return. That's a big win. 37 or 32% if you sold that every single month. So I like Kroger for that idea of just selling a put. maybe let it stop falling, but I like the idea of stepping into these grocery stores as they're both a defense sector and they're paying almost 3%. And because if prices got better, their margins are going to improve. Now, like I said, I did like TAP as well, but this is benefiting from the boycott of Budweiser, I'm sure, at some level. Big day today, huge day today, gaining 3.6%. This is simply winning out market share being priced in, but it would have worked before. It would have worked as an opportunity to buy as a defensive sector, and also from the idea that we're looking for an opportunity to benefit from better margins from these manufacturers of beverages. And as a side note to this one, again, same 1 month time frame, you can see that we're getting paid about 2.6% for our willingness to even buy it at the current price. Just saying, yeah, I will sell a put and lock in a 2.6% rate of return. Let's check Coca-Cola and Pepsi. 1.3 for the first step out of the money, and Pepsi at 1.2. So TAP and Kroger are roughly that 3%, 2.6 to 3% for selling puts at the money. And that'll give us something that can trade not just this month, possibly the next month and the next month and next month. Let's just let Kroger stop falling and possibly consider looking at TAP as an opportunity on any type of a pullback for a better premium and being willing to sell puts if it continues to rise. Last comment, we'll be focusing on the SPY, and with the SPY, you can see this move through here. We had an inside or a small candle day, a higher high, lower low, big bearish candle, a bearish engulfing candle at a resistance or supply area. And then today we gapped up, closed higher, so we have higher highs, higher lows, higher close, eliminating and destroying a bearish engulfing candle. This is a significant technical breakout. And as far as the short term, it is still an area that has sellers. If we clear 415, we could be on track to go up to 425 to 427, which is looking for another 3 to 5% rise in equities. If we fail here, because the market's still undecided on what to do, I still like Kroger's, I still like TAP as far as a conservative defensive position in consumer staples that are probably going to benefit more because of the reduced cost and price. Well, that's going to do it for me today. Thanks for watching. Join me again next week, and have a great week.